Welcome to SharkCapTable.pro. Keep a bigger bite of equity. Today we're going to redo or add something to section 3, and that is we've added new loans since I've made this video. So we're going to go down to section 3, and the video that's associated with section 3, located right here, is still apropos. There will be some new things added to the bottom. I'd like to show you the full screen here because we have some things below that you're not going to be able to see, but we're having our loans down in here. So basically everything is the same, except I've added for clarity the months that are associated with the year because we put new loans on at the beginning of every year, and the term, whatever it is always at the end of the year, and it could extend further on. So let's scroll up a little bit so I can show you what we've done here. I've set this at the low revenue, but you can again try it here, and you have to wait. Don't be impatient. There's a huge number of calculations going on here. But notice what happened here. In the first one, we had a turquoise line here. We have 3 loans, one each for low, medium, and high scenario. And I don't want you putting a high loan in a low scenario because it doesn't work that way. It's a one-on-one. So if you click it one more time, you can see that the turquoise goes to the bottom right here. Okay, so let's go back because the numbers are easier and better to show if we go down to the low. Now remember, pink is not pleasant. Pink is not your friend. Pink means you have a problem. So we have negative cash flow. Now the beginning cash was $100,000 and the ending cash is $35,000. The reason that is we've left some residual loans. So I'm going to go down here and I'm going to turn those off, and I'm going to turn off the term in months. So I'll leave the interest rate at 9%. Now this is a little different. We have more pink. That means we have more problems. So the cash flow is a minus $139,000. The beginning cash came from the founder, and we're still $39,000 in the hole, which would carry forward to the next period. Let's see what we can do about putting a little loan together. Now, I don't think you're going to be able to do this in real life, but for the numbers here, we're going to play like we're going to do a loan. So the first thing we're going to do is we're going to ask ourselves, when do we want to do this? Well, obviously, if you got a problem in the first year, you better do it in the first month. And the way I've got this set up is we have a monthly loan calculator that goes out 120 months. So I've stolen it from another program I wrote, and since we've just got years in here, I've set this up so that we begin in month 1 or 13, and that would be the beginning of the second period, and 25, of course, would be the beginning of the third period. So we now want to put a 1 there, and let's try a 3-year term. Now we're going to have 9% interest, and right here is where we're going to crank in the loan amount. But I want you to watch what happens to this area right up in here when we start cranking on the loan. So here's the first $50,000. See, now it's improving a little bit. Now down here along the green line, which can change from green to yellow to red as our debt to equity worsens. Right now we're in the good period, so that's okay. Let's see what happened when we go to another 100,000. We got to get rid of this pink here. Okay, so if we borrowed 100,000 at the beginning, we would have a little extra cash flow, a little extra cash at the beginning. That would be fine. And we have a reasonable debt to equity ratio. So hey, maybe it could work. But I want you to see something that's very tricky what goes on next. Let's just assume we want to borrow a lot of money. Watch carefully what happens along this line. Now we're going to borrow $150,000. Ooh, now our debt to equity is in the yellow section, and this went up a little bit. Watch what happens again. I want you to watch what happens when we go from 150 to 200. There, it's a little quicker. Okay, let's try something else. And the basic rule is your debt to equity is getting worse as the loan amount gets bigger. Well, that seems pretty intuitive. Let's go back to about a $400,000 loan. You can see we have a really bad debt to equity ratio in the red. We're okay here, and The rest of that's okay because we've paid off our loan. Remember, if we say 36, that's the third at the end of the third year. So this is calculating net of paying off the loan. Now let's try something else. Let's try extending the term. Maybe we could improve this number here. Let's go to 48. No, as the term gets longer, your debt to equity gets worse. Now, I had to think about it for a while, and I realized what's going on. Remember that a longer term does not reduce principal much, and the interest paid maintains itself, and interest reduces equity. When you reduce equity, you worsen the debt to equity because there's more debt and less equity. Duh! So there it is, folks. You now have the ability to put a loan for low, medium, or high revenue, and you can play the game looking at your debt to equity and how much liquidity or ending cash you have going into the next period.